Hey traders, Stephen Kowitzel here with thetradersplan.com. Headed into the close on Thursday. Have a lot to cover today. Have a lot of charts. So let's look at the disclosures real quick. Make the lawyers happy so we can move on to the fun stuff. Okay. Let's start with the S&P 500, then we'll move on to the Nasdaq. I want to cover the current market conditions, breadth, sector rotation. I want to look at the past corrections because I think it is very, very important to look at what has happened in the past corrections to see what we can anticipate the possibilities going forward. And then at the end, we're going to look at some good growth stocks that are pulling back to some key support areas, so you might want to stay tuned for that. So then the S&P 500, right, the 2008 started right here. So we're definitely down for the year. Started off nice bull market. It's interesting. Right now, the S&P 500 is really doing a second test of the long-term moving average. So if this 200-day moving average breaks, I'm not really that worried about it. If it breaks, I'm more looking for the reversal like this. So, I'm kind of anticipating if we have a crack, I'm looking for that reversal to come in and step in just like it did right here. So, I wouldn't be surprised if that happens. As we're going to look at past market corrections, there can be a lot of choppy action towards the bottom. This is where whipsaws happen. So, you have to, I just read a really good book, or I'm in the middle of reading a really good book. It's called Man of All Markets, Edward Thorpe. And he talks about probabilities and betting more when the odds are in his favor and betting less when the odds are against him. Right now, the 20-day EMA, this green line, is curling down. So we are in a downtrend. We are in a downtrend correction. Excuse me. We're not in a bear market. We're in a correction. And if you just are ever curious whether we're in a correction or whether we're in a downtrend uptrend, just follow the 20-day EMA. It's simple. It's not a slow mover like the 200-day moving average. It can quickly just give you the eye test to tell you which way we're headed. So this can take a few days to curl up. We're not trying to pick the bottom, the exact bottom. We're not trying to pick the exact top. We want the middle. We want it when the odds are in our favor, wherever that is. And just right now, I wouldn't say the odds are stacked against you, but your edge is definitely smaller with this 20-day moving average curling down in the choppy, volatile behavior that we're in. So just keep that in mind. Good rule of thumb when you have some choppy action, maybe cut your position sizes in half that you're trading. If you take on new positions, just cut them in half. If you're typically buying 100 shares, buy 50 shares. And always have your stops in. Don't let don't ever not have a stop in a correction, because you take another leg down, it can get ugly. One thing I'm noticing on the S&P 500, and it holds true for the remaining indices, is look at all this distribution coming in, all this unloading coming in. It's not a surprise that we took another leg down, because I don't see that many corrections of 10% greater that are V-shaped. I haven't seen that many at all. So typically what happens is they draw you back in, they suck you in, and then just shake you out. So you have to approach the market right now with a shakeout mentality, like, hey, where is the market gonna possibly shake me out? So instead of just always trying to buy these breakouts, which right now it's kind of hard, just anticipate the shakeout. And if you see a shakeout, look at that as an opportunity, not necessarily as a threat. And what I mean by that is if we undercut this 200-day moving average and then you get a nice reversal, run all the stops out, I see that as an opportunity to slowly put some money to work. Now, I say slowly because, again, the odds are against, I wouldn't say the odds are against you, but, you have to understand that we are still in a downtrend. But shakeouts can be good if you can identify them and play them correctly. And if you get shaken out of a stock and then it comes right back, don't be afraid to buy it back. So right now, the S&P 500 on the daily chart, it is holding long-term support, but there is a lot of distribution on today. I'm noticing the S&P 500 and the Nasdaq, they're popping in below average volume, or at least volume less than yesterday on yesterday's ugly day. So when you always pay attention to the price and volume. When you have, you know, more distribution on the down days than accumulation on the up days, you're in a weaker market. So just identify that and have reasonable expectations. And, you know, you don't have to trade it. Just kind of wait for the signals. You don't have to wait for the stars to align, because a lot of times when the stars are aligned, you know, you're way up here. Just, you know, wait for that right opportunity and then step up and swing the bat. Now, if we look at the S&P 500 60-minute chart, which again, I don't really look at these all that often, kind of when we're in corrections, you can see that when we had the sell-off on, this is the 60-minute chart, this 2700 was kind of a key area. So I'm really anticipating to see what happens around this 2700 area, which is about a 1.5% away or so. So we'll just kind of see if that finds resistance. But again, you know, we're kind of paying attention to these areas. Do we take another leg down, or, you know, then retest these lows, or does that rising 200-day moving average hold? So right now, we're really in no man's land. The volatility is high. Defensive stocks are leading. So you just, again, you want to know, you know, identify what is going on out there. And just right now, at least today, now this could change within a couple days, so don't go too bearish on me. But again, just right now, you need to be incredibly cautious. So looking at where we are at in this bull market, going all the way back to 2009, you got several corrections along the way, and all these corrections came down and touched this trend line. Now, I really don't want it to come down and touch this trend line, because probably put us in a bear market, but you just kind of got to see that we really did get far extended. So it might take a little bit for us to work through this, and that's okay, as long as you're not giving a lot of your gains back that you made on this move. As long as you're being cautious, trading less, setting up rules in place, knowing that the odds aren't as good as they were in this nice steady uptrend, you're going to be okay. We're going to look at each one of these corrections one by one and see what we can identify here in just a second. So if we look at the Nasdaq has not came down and touched this 200-day moving average for the second time. It did on the first time, not on the second time, but you know, I'm really looking for these reversal, these flush out lows. As you can see right here, you had a flush out low, you had a flush out low, and not all of them were. You can see you had a flush out low right here, and then that first, sometimes when you start to waterfall, that first test of the declining 20-day EMA, it's going to get rejected, and then it'll come back and take it a second time. Same thing with here. Look at this. You had two gap downs. It came back. It tried to hit this declining 20-day EMA and got rejected. So, you know, it's just like anything. After you have a breakout, on the first bounce, the first test of the 20-day EMA, if you're in a strong enough trend, a lot of times that will hold, as it did on the upside. Same thing is reverse on the downside. If it's a strong enough downtrend, that first test of the 20-day EMA, that first resistance, is going to get rejected. So I've looked at a lot of corrections, I've looked at a lot of bear markets, and I do give more attention to the 20-day EMA than anything, because one, I'm looking, hey, is it declining? Two, how many rejections have we had of that line? Because if we've already had one or two, from what I've noticed, that third luck is a charm, or even second time is a charm. But typically that first time, it gets rejected, as it did in this most recent one. So, you know, we'll just continue to see what it does. But I am looking for breakouts above that 20-day EMA. But I'm still looking for opportunities. But look, down here, you have all this distribution right here. So this isn't me or you selling. I don't move the market, and I doubt you do either. These are the big institutions, the big mutual funds, you know, selling the FANG stocks and stuff like that. So again, this could be the bottom right here, and we could be good. You know, the volatility is high, so just really keep that in mind. Reversals are a really good place to pick an entry if you're looking to slowly wait in the market and put some money to work. let's look at some corrections. I want to start with the 2015 correction in the S&P 500. And, you know, these are good lessons, guys. They really are, you know, to look and see what has happened in the past corrections, because I think, especially when we're coming out of just a major, you know, 18-month or however long, just major run, let's just call it since the election, November of 2016, a year and a half, we've really had good environment. Sometimes we forget what it's like to really have a more challenging environment. So let's look at 2015. I see lots of things here. Let's talk about the declining 20-day EMA, because that's the only line I have on here. Everything else is noise, because when you really don't have a trend, you don't really need the 50 or the 20 or the 200, excuse me. So you had a waterfall, came back, didn't get, you know, like right on it, but I'd say that was a 20-day EMA rejection. Got slammed down and tried to come back up again, punched through it, got slammed down again. So I see two double bottoms. I see a bigger double bottom right here, right? And then I see a mini double bottom within each leg, okay? So when you have a mini double bottom right here, you're really looking for this middle of this pivot to clear, okay? Or a reversal like you did right here. Not a bad place to put some money to work when you get a reversal right around this. So then you had a market broke out right here. Really, really nice uptrend to play, and then it starts to get choppy again. So when you get, and you will, when you're coming out of corrections, you'll get these nice uptrends. You'll think everything is hunky-dory, right? And then you'll get sucked in, and then you'll get slammed back down. So that's why it's really important to pay attention to the 20-day EMA, because it's hard to make money when the market just continues to grind under the 20-day moving average. Like there's not a lot trending up, so you just have to keep that in mind, which is why I like using it. So then we had a choppy around. Boy, this looks a lot like it just did when we just had another sell-off, right? Almost looks identical to our current situation. You had a leg down, leg back up, some chop in the middle, leg back down. Now this is interesting. You didn't really have any green reversals, but look at these long wicks right here, right? Some support stepping into the market. Again, you had it try to break through, it rejected, and then you had a market breakout, and then this one worked, and then you went into an uptrend. So, you know, again, you're looking for these double bottoms, but really two things you're looking for. When you're coming out of these corrections, one, you're either looking for a flush out low reversal on a green day. That's signal number one. Signal number two, you want a market breakout where it's punching through the 20-day EMA and above average volume. So you have a market breakout on this day right here, and then it goes into an uptrend, and then you go a downtrend. I wouldn't identify that as a reversal. But what you do have is a market breakout on this third day right here, and then you go above the 20-day moving average, and then you go into an uptrend. So again, market breakout above or through the 20-day moving average. Make sure it holds, because you can see right here, it broke through, and then it tried to get slammed down, try to shake you out, but found support. I've seen that time and time again. When it tries to break through, holds the 20-day moving average for a couple days, gets slammed down, but finds support and will continue its uptrend. So it is when the market breaks out. This was a smooth sailing after the breakout. They're not all like that. A lot of times they will just chop and chop and chop, and sometimes it's just like that coming out of correction. So just keep that in mind. You know, it's not always smooth. So let's look at the 2011 correction. Now, in my opinion, let's just go back to 2015, so you can kind of, you know, take a mental note in our head. I think this one, even though it sucked, is a little bit easier because there's clear trends, whether it's up or it's down, than the 2011. So right here, hold on, let me just, right here, keep in mind, this is 25 trading days, okay? This is 16. Actually, this day to this day is 16 trading days. So let's just show you that when you're bottoming, you can chop around for 2 to 3 weeks, just chopping the bejesus out of you. So just keep that in mind. Keep in mind that V-shapes don't happen typically. So you're going to chop around for 2 to 3 weeks at the bottom, and then you're going to come out of it through a breakout. Let's look at the 2011. Now this looks like it. I remember this. I was actually a financial advisor, and I think this is when the S&P 500 got downgraded or somewhere around here. The correction started way up here, but let's focus on the waterfall. Waterfall. You try to have a reversal right here. Did not happen. Got close to the 20-day moving average. Just got slammed down. Reversal. This reversal held for a little mini rally, and then it just got slammed down. So you chopped around. So from this day to this day, that's 39 periods. So from August 9th to the middle of October, let's just call it a month and a half, this was chopping you up and spitting you out. And what I want to do is I want to attach the VIX to this. Let me price out the VIX just to see what the VIX was like during this period. You can see right here, let's get this. The VIX held above 20 this whole time, okay? So this whole time, and while you were getting chopped up and spit out, the VIX held above 20. So another good rule of thumb is if the VIX is trading above 20 and it's really trendless, just step aside for a minute, because it's just really, or trade a lot less, because again, you want to trade when the odds are in your favor. Sometimes the market will just not put the odds in your favor, and a good way to step this one out for 39 periods is just to see what the VIX was doing. Volatility is high, where you're in a bearish situation, so just be mindful of that. Then you have a flush out low. This is beautiful. Absolutely beautiful. So you have an undercut shakeout. I like it. I love shakeouts because I see them more as an opportunity than a threat. So you had this undercut of this low, ran out all these stops, all these longs, found support, then the market broke out on this day right here. You could call this a breakout, but definitely on this day. So now you have a new uptrend, right? Because one, you had a flush out low, and two, you had a breakout. So that's your second signal, right? And then the market is headed higher. So again, you're watching the 20-day EMA, and it tries to shake you out twice. This would have shaken me out. I probably did. I don't really remember what I was doing on this leg, but again, it tried to roll back over and found support. So it's not all cupcakes and rainbows when you're coming out of a correction, and you have to be very mindful of that. So just follow the 20-day EMA, and when it starts to chop around and goes trendless again, then maybe you want to scale back your new positions. If you got a current position that's working, that's great, but scale back your new positions, and then boom, we have, this is probably a breakout right here, and then it's a lot smoother coming out. So volatility just takes time to work itself out, because you can see the VIX didn't get down to 20 until right here. Right 20, let's just call it right here, this day. So all of this whole box right here, the volatility was above 20. So again, I don't trade the VIX, but it is a secondary indicator, because when you're trying to figure out, what kind of market you're in, you want to look at the weight of the evidence. You try to be as objective as possible. And one, if you got a declining 20-day EMA, you got that working against you. Two, if you got a high VIX above 20, you got that working against you. So you continue to just look at everything and say, okay, based on the evidence I'm looking at, I'm seeing this is a more challenging environment. Doesn't mean I can't make money. It just means it's more challenging. So I need to make sure that I am trading accordingly, so I get out of this without getting hurt. Oh yeah, let's go look at the 2010. Okay, so actually I want to do what I did last time, and I want to add the VIX to this one too. Where am I looking? Should have had that prepared, but then you got the VIX. I don't know why that says SVI. Okay, so we have the waterfall that started happening. So you get this first flush out, and I'd probably say it really started to get trend lines started to break up here. So then you got this first flush out, and let's just go all the way over here. I mean, really, it chopped around. That's 94 periods, May to September. I mean, I'm looking at 4 months right here. I'm not saying, you know, don't take 4 months off, but I'm just saying, like, you know, sometimes these corrections, after you have a really, really nice move, these corrections can just take a little bit, right? So just know what has happened in the past and have your rules so you can identify. And if you follow your rules and it still doesn't work out, at least you're not plunging in. You know, slowly scale in and slowly scale out. If you have stocks that are holding up, keep them in place. Don't go selling everything. That's mistakes I used to make. Every time the market pulled back, I'd sell everything right when the market was bottoming. So, you know, always know where you're going to get out in case something gets really, really bad, though. I don't think we're there, by the way. I just think we're in a correction. So, and you can see right here, down here, this whole time, the VIX was above 20. Interesting how the market continues to repeat itself. So you had all these flush out lows that really didn't work. So it just goes to show you sometimes that, you know, when you're a trendless, you're trendless. But you probably had a market breakout right here, and you probably rode it for a few days, and then it started to kind of chop around. So you might have had a nice little trend right here. But again, you know, this is a clear breakout right here, okay? So you have a flush out low right here, or flush out of this downtrend. Boom, bottom was put in. You can see the long wicks right here. Breakout above the 20-day EMA. Now you're off to a nice uptrend. Correction, pullback, that's going to happen. It doesn't go straight up, but look at that. So again, you know, watch the VIX, watch the flush out low, and then look for the breakout, okay? Hope that was helpful. I love looking at history of the market because it's just, it can help you so much. So the S&P 500 right here, we'll see what this is the breadth, the percentage of stocks above the 200-day moving average, but you know, it's in a correction. It's under 60. It's under 60. It's headed down. It's in a downtrend. It might perk up after today once the dust settles, but you know, I don't really pay attention to the percentage of stocks above the 50 or above the 20, but you know, it's clear to me that's not great. That's not great. But the big trend is in a correction, but it's still up. So what's healthy is when the 60% of the stocks are above the 200-day moving average of the S&P 500. And right now we're just chopping around. Again, I'm really not doom and gloom. I try to stay positive because the market does have a long-term upward bias. So just wait for the opportunity. When you get that fat pitch, step up and swing it. If you miss, you got more strikes. That's fine. It's going to happen. What's interesting, though, is the dollar. Where are you? Oh, dollar, oh, dollar. So let's look at the USD right here. I thought it was looking like it was going to crack. It got so close to undercutting this right here, and it's bouncing back, which is interesting because I was thinking when this was looking to crack last week, gold was looking like a few gold stocks were breaking out, and then dollar bounced, gold, you know, shook you out probably if you have a short-term stops. So I still kind of think this is a short-term bottoming pattern for the dollar. And it could break out of this little mini range and then really test this longer term downtrend line. But this is the S&P 500 versus the international stocks, which has been underperforming. The S&P 500 has been underperforming international stocks, broke out relative to international stocks, and then is pulling back down. And I would expect that if the dollar would strengthen, U.S. would outperform international stocks again. They would retake this downtrend. This is the Russell 2000 small caps versus the S&P 500. Small caps leadership follow the dollar. So we did have a breakout. Again, anytime you see a breakout, they typically don't go straight up. They'll break out, they'll come back, they'll test the trend line, they'll wiggle around a little bit before they resume their uptrend. But if you get in a nice uptrend with the dollar, small caps typically follow the dollar as far as leadership. So that might be, if you're an ETF, trend follower, might not be a bad place to consider just looking at the intermarket relationships. The VIX. The VIX is declining today. That's great. It's still right at 20. So, it's not an exact support resistance. It's not an exact science. This is a basket of put options. But it's in this range, right? And just like anything, when you have a basket of stocks, you're not looking for exact support or exact resistance. It's a range what you're looking at, because all the components of that index are going to move with it. But VIX is lowering today, which is not a surprise because the market is up, and it will. But again, it's still high. And today's pop is not on above average volume, so it just continues to have me cautious. Doesn't mean I don't swing the bat when I'm cautious, because I do. Just took some profits earlier, but it just means I'm cautious. Let's go to sector summary. Let's do that. So technology, energy is up today, utilities is down, and that's what you want to see. You want to see the more consumer staples and utilities towards the bottom on the update because they're defensive. I want to go back and look at the last month just to show you how much leadership has really rotated. You have these three that have basically the worst scooters outside of materials. Utility has the worst scooter. Energy and staples are in the bottom three typically. Now in the last month, they're rotating towards the top, as you can see by this percentage change. So really in the last month, only utilities and energy are up, and mainly because energy is up pretty good today. And technology and financials are at the bottom. Cyclicals are in the middle. But look at how the money has rotated in the last month to more of a defensive play. So I think there's a lot of opportunity to buy some really good companies in the technology and the finance sector. Energy is looking like it might have turned a corner. We can look at that here in a minute. But it's just important to look at the rotation on a daily basis, on a 1 week basis. Defense is winning, and on a 1 month basis, just to kind of look at what kind of environment. Again, you're looking at all the evidence in front of you. You're trying to be as objective as possible, and the money is in defense right now. The 20-day EMA is declining, but we are, the positive thing is we are at long-term support. And I'm bullish on America all the time. I can't help it. This is a great country, and if you don't like it, I'm sorry for you. So sector summary, let's look at some industry ETFs. Let me go back. So let's just look at let's look at the individual industry ETFs. So materials is up big today, but it's below the 200-day moving average. I'm looking for relative strength, and that is not showing me relative strength. I don't know why it's doing that. XLE, it's so weird because it just sold off more than anything in February. It didn't bounce at all, but the interesting thing is it hasn't gone down at all either. It's been showing relative strength. It's just been trading sideways. And I'm more interested to see if it can start break out of this little mini downtrend. But breadth is not exciting, so I tend to think that it will continue down. But it's hanging in there, so it's something worth noting. XLF did a double bottom test of the long-term moving average. It's holding, it's firming up. That is good. So right now you're looking for the strongest sectors that are holding up. You can see breadth is still bullish in the financial sector. So I'm good with financials. Industrial, again, did a double bottom. It looks like it's showing a little bit more strength in financials because it didn't come all the way down to this second leg and is bouncing pretty nicely. So industrials are looking okay. I say okay, that's a relative term. Still looks like crap compared to the February high, but it's doing okay relative to some other counterparts. XLK, the 800-pound gorilla technology, didn't even come close to touching the second leg. You know, it was up to most today, but with the FANG stocks selling off, Amazon, Facebook, all those, you know, it could underperform for a little bit, but in my opinion, it's still holding, it's still hanging in there. So it's kind of hard to get out too bearish when one of the most aggressive sectors is holding up the best. XLP, the 50-day is under the 200-day, death cross. But it's large and in charge. It's trying to come back, but you know, it's not really something I'm paying attention to. Maybe breath's starting to get a little better, but again, you got the death cross. It's in a downtrend. It's one of the worst sectors in the last 12 months. Not really something I'm focusing on. Same thing with utilities. You got the death cross, but again, you could draw a trend line over here, maybe a little mini head and shoulders. Trend line right here. It's about to test. It's about to test this trend line. It's about to test that 200-day moving average. So we'll see. In the short term, you can see the percentage of stocks above the utilities above the 20-day. Short term is bullish. So in short term, they are in a little uptrend. It could just be counter trend, probably just because the market's selling off. I'm looking for, you know, stocks that I think are really going to move bullish. You got healthcare right here. Healthcare, I don't have a 200-day moving average on this. I don't know why this thing is so huge. I just won't worry about it right now. You know, it did a double bottom test right here. It's probably sitting right at that 200-day moving average. So, discretionary, also looking pretty bullish. It didn't even come close to the 200-day moving average right here and didn't undercut or touch this leg down here. So discretionary, I think, is holding up just fine. So again, we're looking at relative terms. We're looking at, yes, it is in a downtrend, a short-term correction, but relative to what everything else is doing, how's it holding up? Okay, so we already looked at that. What is next on my list? I want to look at, oh yeah, I remember. Where are you, silly boy? So if you've been following me for a minute, I do feel strongly about certain themes over the long term. I'm looking at the Pakistan stock market exchange. I know that might sound silly and that might sound funny, but there is a Pakistan ETF. Now, why I show this, because I've looked at the charts in the past, and if you use a simple golden cross, death cross rule, weekly chart, 10 week above the 40 week, you're in, 10 week below the 40 week, you're out. Very simple rules. You know, it's just one of those countries like India and some of the Southeast Asian countries that are just really coming online. There's a lot of growth and they have a young population. So what I wanted to show you is, you know, you can see from this golden cross, this stock from the time it went into the death cross, this trend right here is up 651%. Now this is a 5-year trend, so it's not like that's gonna happen overnight. And then you had a correction, right? You had the death cross happen, and then it goes back up 19%. Then you had 2008, you were out up here, and then you get back in for a 58% trend. Got another correction, 172% trend, another correction, 50% trend, another death cross. Why I'm showing you this, because now we got the golden cross. Okay, so the golden cross in this country has just now happened. So it went from 53,000 to 37,000. I'm not that quick at math, but pretty sure that's a bear market. And now you have the golden cross. You can see the blue line going above the red line right here. So if you were just to apply this, and if you could sit through a move like this, most people can't. You know, it's just kind of something interesting to look at. Same thing with India and some of the other countries. Now, but if you look at the Pakistan, the PAK ETF, it has not, I don't have the moving averages on here, but it has not made its golden cross yet. Now, sometimes why that is because of the different differentiation in the currencies. You might have the stock market have a golden cross, but because we've got some currency issues or there, you know, you have to convert them, you don't have quite the golden cross in this. But, so you might want to more pay attention to the golden cross in the ETF, but it already had its correction. Now it's coming back online. This really isn't all that. You can see it's correlated to the market, but the kind of thing that can run to the beat of its own drum. So just interesting idea to look at. Do your own homework, but sometimes I just look at interesting things like this. Now, I've been looking at some interesting stocks that have been some really powerful growth stocks that have been pulling back to the 50-day moving average. So just some interesting things to put on your watch list maybe. You have this AQ in the semiconductor industry. Made a nice move from 10 all the way up to 18, so an 80% move. Pulled back. Really, it has its first test right now, that 50-day moving average. You want to consider buying kind of in a zone close to the 50-day moving average. That way, if you don't, if it doesn't work out and you sell when it falls below the 50-day moving average, you don't have, I typically try to buy it within 5% of the 50-day moving average. Right now, it is pinballing around. It's about 7.7% above it. But, this is an interesting looking stock. It had a lot of power and it has its first test of the 50-day moving average. Now, as we previously seen on the previous lesson, the first tests are sometimes the most successful one. With the kind of fundamentals this has, it has 4 straight quarters of positive sales growth. Earnings per share are expected to go from 10 cents, estimated, 10 cents 2018 to 40 cents a share 2019, an acceleration. This stock is holding up for the most part. It has a rising relative strength line. It has been pulling back. Now this is going to pull back more than the market, and this is going to go up more than the market. But again, you have some pretty nice growth stocks that are really making a nice test of the 50-day moving average. Same thing with FireEye. FireEye, software security, one of the strongest industries. You have a re-acceleration in sales growth. You have a very nice from 2 cents a share to 16 cents a share, 700% increase next year. The market tends to price next year's earnings into this year's stock price. So, this is something that's just really interesting to me. Right now, it's just kind of sitting in that zone, right around the zone. It's about 4% above the 50-day moving average. So if you ever buy bounces, you buy as close to the line as possible, and the minute it breaks the line or closes below it, you're out. You don't let it go to the second line or let it go to another level. You just get out. No questions asked. You always know when you're going to exit, and don't ever lose more than really 8% on a trade. Is where your final stop should be. But this is really looking interesting. My guess is it'll base a little bit. But you had a really nice move, a nice earnings report right here, went up, it shook out, it tried to break out, it came back, tested the 20-day moving a 20-day EMA, tried to retake it, but the market was just too much. And that's just a great example. Like, you can buy it perfectly, but if the market, rising tide will lift all boats. If the market is just not going the way, stocks are going to go, 75% of stocks are going to move with the market. So that's why paying attention to where the 20-day EMA on the Nasdaq or the S&P 500 goes is important, because you don't want to be swimming upstream. But it's great growth stock. I say great. It's only great if it goes up, but and then you have this DESP right here. You can see that it pulled back. Now, this is a Argentina-based online travel services to 4 million customers in Latin America, but it's interesting. You have 38% estimated growth this year, 30% next year. Nice return on equity. 4 straight quarters of sales increase from negative, so it's got its growth figured out. It's moving in the right direction. Now, I'm showing you these stocks. Well, when you are playing a growth stock, you need to always know when it reports, because it can break your heart if the report goes against you, and especially in an unforgiving market, it'll break your heart even more. But this is just an interesting pullback right here. When you're buying pullbacks, you probably, especially the 50-day EMA, you probably want to have a more intermediate kind of time frame. So all stocks to put on your watch list. I'm not telling you to go out and buy it, do your own homework, but interesting play. So let me know if you have any questions. I hope everybody has a wonderful, wonderful Easter weekend, and we'll talk soon.